Index funds are the best investment for 99% of the investing population. Most people, including you, have no business investing in individual company stocks. The only people who should be investing in company stocks are the people who are willing to get up early on a Saturday morning, download the last 5 years worth of financial statements, learn the company's business model in and out, come up with future financial projections, and arrive at a stock price that they'd be willing to pay for that company today. Now, if that sounds like too much work, that's because for most people it is, but that's what's required. Fortunately, there is an alternative: index funds. As a beginner investor, you have 4 main concerns. Number 1, you don't know what to invest in. Number 2, you want to start off with a small amount of money. Number 3, you're afraid of losing money. And number 4, you have limited time. Index funds are the answer. By investing in index funds, you own a small slice of hundreds, if not thousands of companies, which removes the stress of deciding what to invest in. As you'll see in this video, you can own multiple index funds for as little as €100, so you don't need to commit lots of money at the beginning. Index funds have been proven to provide some of the best and most consistent returns over the long term, so you're reducing the likelihood of losing money. Index fund investing also requires virtually no work or time commitment on your part, so you can spend more time doing things that matter to you. It's for these reasons that index fund investing has been recommended by investing legends like John Bogle and Warren Buffett. In fact, in May this year, Buffett reiterated his belief that for most investors, beginners and veterans alike, the best option over the long term is to just invest in index funds. I'm emphasizing this because investing doesn't need to be complicated. So many people are put off by investing because they have this Hollywood idea in their minds that investing is a highly complex and risky process, but it's not, especially when it comes to index funds. Once you've accepted that index fund investing is the best option for you, the question then becomes, which index funds do you buy? This is the main piece of work that you need to do when it comes to index fund investing. Fortunately, I've got you covered. I'm going to show you the index funds that I personally invest in, and not only that, I'll also explain why I went for these particular funds over other options. That way, you'll know what to look out for when comparing funds. Let's get started. The first index fund I own is an S&P 500 index fund. Everyone needs to have an S&P 500 index fund in their investment portfolio. These funds allow you to own a slice of each of the 500 largest companies in the United States. Companies like Apple, Amazon, Microsoft, and Google will all be included in an S&P 500 index fund, along with the other 496 most successful companies in North America. The reason why everyone needs to own an S&P 500 index fund is because the S&P 500 index itself covers 80% of the total value of the US stock market. So, by buying one single share in an S&P 500 index fund, you'll own 80% of the entire US stock market. Why is that a big deal? The US stock market is the most valuable stock market in the world, with the top 500 companies valued at over $35 trillion collectively. These are the most successful companies from the largest economy in the world. So, as an investment, they represent a pretty safe bet. In fact, over the last 50 years, the S&P 500 has returned on average over 9% each year to investors. For context, you'd be lucky to get an annual return of 0.25% on a bank savings account. That's not going to do you any good when inflation is at multi-decade highs. So if you're looking for an investment that will A, minimize the chances of you losing money over the long term, and B, provide you with a very solid investment return, then investing in an S&P 500 index fund is a no-brainer. But which one should you go for? If you search for S&P 500 in the brokerage app that you're using to invest, you'll be met with what seems like an endless amount of results. What's the difference between all of them, and how are you meant to know which one is best? Let me answer that by showing you the S&P 500 index fund that I own. This is the iShares S&P 500 Euro Hedged UCITS ETF Accumulating Fund, which is currently trading for €88. First things first, what is going on with the name of this index fund? Let's break it down. iShares is the name of the institution which offers this fund as an investment. S&P 500 is the index which this fund is offering exposure to. We'll skip Euro hedged and come back to that in just a second. UCITS is the European stamp of approval for investment funds. ETF stands for Exchange Traded Fund, which is what this fund is, given that its shares are traded on a stock exchange. And accumulating just means that any dividends which the underlying stocks earn will automatically be reinvested back into the fund, rather than being distributed to your brokerage account, which is what I always want. So even though these fund names might seem complex, when you actually break them down, it's pretty straightforward. So why did I choose this particular S&P 500 index fund? The main reason has to do with the part of the fund name which we skipped over. This fund is what's known as a Euro hedged fund. If you're from Europe like I am, or anywhere in the world that doesn't use the US dollar, then when you invest in US stocks, you're going to be affected by changes in the value of the dollar relative to your home currency. For example, an S&P 500 index fund, which owns investments that are denoted in dollars, might increase in value by 10% over the course of a year. But if in that same year, the dollar falls in value by 10% relative to your home currency, then your actual return is 0%. They cancel each other out. Many investors fail to account for this when investing in the US stock market. A Euro hedged fund essentially stops this from happening. It allows you to invest in US stocks without having to worry about the underperformance of the dollar ruining your investment returns. Likewise, if you were from the UK, you'd buy a GBP hedged fund, or from Australia, an AUD hedged fund. Now, of course, this can work both ways. Hedged funds prevent you from benefiting in any positive returns generated by currency movements. But for me, I'm investing in the S&P 500 because I want exposure to the stock performance of North America's biggest companies. I'm not investing in the S&P 500 to get exposure to the dollar, and for that reason, hedged funds suit me best. The other option I could have gone for was the Vanguard S&P 500 UCITS ETF accumulating. This index fund has a total expense ratio of 0.07%, which is essentially the annual cost of investing in this fund. Even though this expense ratio is lower than the iShares fund which I'm investing in, which is 0.2%, the Vanguard fund isn't Euro hedged. And in my opinion, the slightly higher total expense ratio for the hedged fund is worth it considering the protection it provides against adverse currency movements. So that was my thought process behind the choice of S&P 500 index fund. And again, one share in this fund will currently set you back €88, which makes it very accessible to everyone. Outside of an S&P 500 index fund, what other index funds should you invest in, if any? When I was building my index fund portfolio, I was keen on the idea of having control over how much exposure I have to any one geographic location. If an S&P 500 index fund was to be my only investment, then my investment returns would solely be dependent on the performance of US companies, which, as we've already established, has been a sound investment historically. But despite this, I decided to diversify my index fund investments by adding 2 additional geographic locations to my portfolio, the first of which was Europe. My European index fund of choice is the iShares Core MSCI Europe UCITS ETF Euro Accumulating. There are a couple of differences between this fund and the last fund which we discussed. First of all, instead of tracking the S&P 500 index, this fund tracks the MSCI Europe index, which is a very similar index to the S&P 500 in terms of what it's trying to achieve. By investing in an MSCI Europe index fund, you get to own a slice of 429 of the largest companies from 15 developed countries across Europe. This one fund covers 85% of the total value of European companies from developed European nations. So by buying one share in this index fund, you'll own 85% of the European market. The second difference between this fund and our last fund is that this fund is unhedged. Now, you might be wondering, Dan, why would you need to have a hedged version of this fund if it's investing in European companies and you use the euro? The simple answer to that question is that some of the companies in this index are based in European countries which don't use the euro, like Denmark, Norway, Sweden, Switzerland, and the UK. So even though it is a European fund, there are many different currencies within Europe itself, and therefore we still have some level of currency exposure. So why didn't I hedge this exposure away? Truth be told, I didn't think it was necessary. Unlike the S&P 500, which which has 100% exposure to the dollar, the MSCI Europe Index at least offers mixed exposure to different currencies within Europe, including the euro. By looking at the country weights, we can see that 25% of the fund is made up of UK companies, which gives exposure to British pounds. 16% is made up of Swiss companies, which gives exposure to Swiss francs. And 36% is made up of companies from France, Germany, and the Netherlands, which gives exposure to the euro. The remaining 23% is made up of companies from the other 10 European countries within the index, most of which use the euro. Because of this, I was happy to go with an unhedged version of this fund. And to be honest, having some level of currency exposure outside of your home currency isn't necessarily a bad thing, because if anything, you're improving the level of diversification that you have within your investment portfolio. The same could be said if you wanted to invest in an unhedged S&P 500 index fund. It's entirely up to you. But because I know the majority of my invested capital will be going towards the S&P 500 fund, the effects of the dollar would be quite large on my returns, hence why I decided to hedge that risk. The last point to address on the Europe fund is why I went for this particular iShares fund over, say, the Vanguard FTSE Developed Europe UCITS ETF Euro Accumulating Fund. You'll notice that the Vanguard fund has a total expense ratio of 0.10%, which is slightly cheaper than the iShares fund with a total expense ratio of 0.12%. Plus, the Vanguard fund offers exposure to over 100 more company stocks. So why did I go for iShares? Truth be told, I made this decision on the back of a misunderstanding about ETF liquidity. You see, at the time I was deciding between iShares and Vanguard, I could see that the iShares fund had much higher daily trading volumes than the Vanguard fund. When it comes to individual company stocks, the higher the trading volume, the better, because that indicates a more accurate valuation for the stock and higher liquidity in the event that you need to exit your investment in a hurry. That same logic doesn't apply to shares in ETFs. ETF liquidity is dependent on the liquidity of all the different company stocks which the ETF itself owns, not the trading volume of the ETF shares themselves. I didn't fully understand this at the time, so I incorrectly decided that it was worthwhile to pay a slightly higher expense ratio for the benefit of higher liquidity. So why haven't I swapped from iShares to Vanguard? Honestly, 0.02% isn't a big deal. While I likely will swap to a cheaper fund in the future, for now I'm happy to continue to own the iShares fund, primarily for tax reasons. But for you, the viewer, the Vanguard option could very well be the best play. As of recording, the iShares fund is trading for €61.75 and the Vanguard fund for €35.11. Again, both very accessible. That brings us to the final index fund in my investment portfolio, and this fund is concerned with emerging markets. The fund in question is the iShares MSCI Emerging Markets UCITS ETF USD Accumulating Fund. This fund offers exposure to over 900 different holdings from countries like China, Taiwan, India, South Korea, Brazil, and many more. Essentially, markets which are emerging into developed nations. The reason why I went for this particular fund is simply because it had the cheapest expense ratio of any accumulating emerging markets fund that I could find, standing at 0.18%. I did try to invest in a euro hedged version of this fund, but at the time I was looking, I couldn't find one. So if anyone has any luck in finding a euro hedged version of this fund, let me know in the comment section. There isn't too much to say about this fund other than the fact that I wanted to have at least some exposure to emerging markets in my portfolio. There's been lots of talk about the growth potential of emerging markets going forward, and how the likes of Chinese companies are disproportionately undervalued relative to the level of GDP produced by China. This article, for example, states that the US accounts for 60% of the value of the global stock market, but only 24% of the world's GDP, whereas China accounts for 18% of the world's GDP, but only 3.6% of the value of the global stock market. Now, of course, emerging markets come with their fair share of risks, like political instability, financial statement manipulation, and currency concerns. Despite this, I do think that there's a place for an emerging markets index fund, if even a small percentage of a total index fund portfolio. I think the iShares fund is a great option for this because it has over 900 holdings and is therefore very diversified, which in my opinion is essential given the heightened uncertainties which come with investing in emerging markets. This particular fund is currently trading for €33.37 and again is very accessible. So those are the 3 index funds which I'm currently investing in. For those of you who are more familiar with index funds, you might be wondering, Dan, why didn't you just invest in an all-world index fund? For those of you who don't know what an all-world index fund is, it's essentially one single fund that covers many, if not all, of the markets which we've discussed. So instead of owning 3 separate funds, you just own one. The main reason why I invest in separate index funds for separate markets is because I like to have full control over my cash allocation to different regions. For example, if I wanted to reduce the amount of money going towards US stocks tomorrow, I'd simply stop buying shares in the S&P 500 index fund and increase the amount of money going towards the Europe fund or the emerging markets fund. With an all-world index fund, I can't do that. Plus, I find that most all-world index funds are heavily weighted towards US companies anyway, which turns them into S&P 500-esque funds. But I want to hear from you. What are your thoughts on the 3 index funds that I'm investing in? Are you investing in index funds? And if so, which ones and why? Let me know in the comments. If you want to check out the brokerage platform that I personally use for investing, or any of the brokerage platforms with whom I'm affiliated, you can do so for free by using the links in the description of this video. This video might have given you some inspiration to start investing in index funds. But if you haven't watched this next video, you're not quite ready to do so. This is the video that will equip you with the knowledge about index fund ETFs, which is needed to be a successful index fund investor. Make sure that that's the next video you check out. I'll see you soon.